Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Partial truce. The US says Russia and Ukraine have agreed to a ceasefire in the Black Sea, ensuring safe navigation on shipping routes. But the Kremlin says a deal depends on some sanctions relief. US copper futures surge on a Bloomberg report that President Trump could slap import duties on the metal within weeks. The president also says he wants to limit exemptions on reciprocal tariffs. Plus, the UK Chancellor looks to slash billions in spending as the government faces global headwinds and critics within its own party. We look ahead to Rachel Reeves' spring statement. Good morning, happy Wednesday. European futures looking for direction after posting gains of around 0.7% yesterday. FTSE 100 futures here in the UK on a day, of course, where the Chancellor will be in the spotlight around the spring statement. Currently flat as well for FTSE 100 futures. There's a focus on CPI, that data crossing at 7 a.m. in UK time. We will break that for you with an expectation that top line number will come in at around 3%. S&P futures stateside after 3 days of gains for US stocks. Ended up 0.2% by the end of the close, currently flat as well, pointing to modest losses, I should say, of about 0.1% for the S&P futures. Nasdaq 100 futures after some decent gains yesterday of about 0.5% by the end of the close, currently pointing lower by 28 points. Let's flip the board and have a look cross-asset. The consumer data out of the US in terms of the consumer sentiment survey pointing to a significant slowdown for the month of March, the lowest and biggest drop that we've seen in about 4 years. And that does remind us that consumers in the US are concerned about the tariff impact. They're concerned about higher prices. 4.33 on the benchmark US 10-year. Yields moving 2 basis points in the session today. The pound in focus, of course, ahead of the spring statement. But prior to that, the inflation data, the UK 129 right now on the pound, down 0.1%. And copper, this is on COMEX. This is the listing pricing on the exchange in the US, up 1.5% in the session, diverging significantly now from the benchmark pricing here on the LME in the UK. This on the tariff story, but also on Bloomberg reporting about Glencore restricting or at least temporarily suspending some exports from the market in Chile. Brent at 73.30 currently on oil, up 0.4%. Let's briefly check in on the Asian markets for you today as well. The benchmark MSCI Asia Pacific Index currently up 0.3%. A little bit of revival in those spirits when it comes to what is happening in China, particularly on the HS Tech Index. Tech in focus again, a deal between Alibaba and BMW around integrating AI. Currently, HS Tech up 1% after some softness yesterday. The CSI 300 on the mainland, of course, in China, down 0.1%. And over in Japan, the Nikkei gaining 0.8%. Let's get to the geopolitics. The focus, of course, on the talks between Russia, Ukraine and the US, because the US says Russia and Ukraine have agreed to a ceasefire in the Black Sea. The Kremlin confirmed the truce, but says it is conditional on lifting sanctions. Let's get the details with Bloomberg's Oliver Crook. Ollie, what exactly was agreed to between these three sides when it comes to this partial ceasefire in the Black Sea then?
Well, Tom, let's get to the sort of theory of what's been agreed to here, because obviously for the United States, who's been trying to basically encourage to get both of these people, the Russian and the Ukrainian side of the table, to get incremental steps toward that full ceasefire, this is going to be another step there. This is basically also the enforcement of the energy ceasefire that had already been agreed to a little bit about a week ago, where basically there's no more striking on energy infrastructure. But the idea here is to basically restore commercial shipping within the Black Sea in order to basically try to normalize that situation a little bit further. The issue is that we had basically 4 different statements out from these meetings, 2 from the White House, 1 from its basically meeting with Russia, with another one from its meeting with Ukraine, the Kremlin statement and the Ukrainian statement, and they don't all totally align, Tom. So this is basically what we heard from the United States, saying that basically that they will help the Russians restore access to the world market for agricultural and fertilizer export to lower maritime insurance costs. These are basically abstract ambitions, right? Basically ways in which they're going to help the Russians get back to the market. When we saw the Kremlin statement, on the other hand, they basically said that they will agree to this sort of situation in the Black Sea and this sort of partial ceasefire only if there is a lifting of sanctions, removal of sanctions on financial institutions involved in ensuring international food trade, their reconnection, these financial institutions, to SWIFT. We remember the SWIFT payment system is at the center of the sanctions regime against the Russians. Also removing sanctions on companies that are producing and exporting foods. Also removing sanctions on basically any ships that are flying the Russian flags that are involved in the sort of food trade, right? So the next question is going to be basically how much daylight is there, again, and we don't really know the answer to this question, between how Trump sees things and Putin sees things, because the Trump administration has been very basically active in saying that basically the ceasefire is effectively agreed to at the highest level. They just need to work out the details. As we get closer into the actual nitty-gritty of what is being agreed in these conversations, how enforceable they are, that is going to be the sort of principal question going into a sort of full ceasefire, which the Trump administration would like to reach before basically April 20th, which I think seems very ambitious to many of the sort of observers from Ukraine and Europe.
Yeah, and Trump himself, in an interview yesterday, conceding that possibly the Russian president is slow-walking negotiations. What are the next steps from here then, Ollie?
Yeah, so listen, I mean, that interview was very sort of interesting, but I think that the next steps as far as we're concerned is basically to see what the commentary is from the United States as to whether or not this is basically what they've agreed to with the Russians. There's a big question basically of enforceability. If you start to sort of have Russian ships flying, their flag, are they basically only carrying food supplies and fertilizer? How do you basically enforce that? The Trump administration, again, wants that full ceasefire by January the 20th. Again, as you mentioned, I mean, he was on Newsmax talking about basically he's been in very similar positions in deals in sort of real estate where basically he doesn't really want to sign the contract but wants to stay in the game, and he's saying that that's maybe what Russia is basically doing. Our attention as far as Europe is concerned is basically looking at this EU emergency leaders meeting that is going on in Paris tomorrow. The reason that Europe is now becoming a little bit more relevant potentially in these conversations is that if SWIFT reconnection is on the table, this is part of the European sanction regime, so they're going to have to discuss that. But really for the Europeans, the main event is going to be basically discussing what they're willing to put forward in terms of security guarantees and durable ceasefire for the Russians and the Ukrainian peace deal for Donald Trump, which is, of course, the principal question before European leaders. What can they bring to the table?
OK, so some progress, but a lot of details that still need to be ironed out. Bloomberg's Oliver Crook with the latest and the update. Thank you. Now, US President Donald Trump says he plans to limit exceptions to his tariff push. It is the latest cryptic hint about a planned April the 2nd announcement of reciprocal duties on global trading partners. This is now a daily event. For more on this, let's bring in Bloomberg's Valerie Teitel, who on a daily basis has to chart, of course, the market reaction to the Trump tariff rhetoric. Valerie, how are markets positioned today on the latest commentary from the president?
Look, Tom, there is a lot of confusion out there. Will these tariffs be limited? Will they be lenient? Are they going to be reciprocal or less than that? A lot of confusion out there, but it needs to be said it has not been rattling the equity market in the last few sessions. The S&P 500 yesterday has now clocked 3 straight days of gains. That's something we've not seen for the index since early February. So risk sentiment is on a better footing. Maybe we were just reading through all of these comments from the Trump administration, waiting for the April 2nd implementation instead. One other thing that the U.S. equity market shrugged off yesterday was the consumer confidence miss. There was a miss when it came to that Consumer Board consumer confidence headline number. Also, look at the 6-month forward expectations number. It's at the lowest level in 12 years, Tom, but the market was really shrugged this off. I think that's telling us that we already know consumer confidence is low, but we need to see it impact consumer spending until we start getting worried about the outlook for the equity market. And to that, guys, Tom, we do get that consumer spending data, the personal spending data on Friday. So hold fire for that one. So the equity market not too rattled. One market, though, that is being rattled by the recent comments from the Trump administration is the copper market. Bloomberg has reported that the Trump administration is looking at copper tariffs to implement them in a matter of weeks. We're now seeing this divergence in between COMEX copper and LME copper as COMEX copper hit a new record high overnight. This is something that is very unusual for the copper market as we're seeing traders trying to scramble in some way to import copper before these tariffs are implemented.
Yeah, unprecedented divergence in terms of the pricing on the COMEX exchange in the US and the LME here in London. Bloomberg's Valerie Titel, thank you very much indeed on tariffs and copper. Now to the UK. Chancellor Rachel Reeves due to unveil the UK's spring economic statement today. She's expected to slash government spending by billions of pounds in the face of higher borrowing costs and a weakened outlook since her October budget. Bloomberg's Lizzie Burden is at Westminster for us. Lizzie, there's been a lot of drumbeat leading up to this statement. Just frame the importance for this politically and economically for this nation.
Yeah, good morning, Tom. Well, this is not what Rachel Reeves would have liked to be doing today. If it were up to her, we would only have one fiscal event a year, and this today would just be a routine update to the Office for Budget Responsibility's forecasts. But because of the sluggish growth in the UK economy, which, by the way, she would blame on global factors, in other words, Donald Trump's trade war and the legacy from the Conservatives, and because of the rise in government borrowing costs, in other words, this rise in gilt yields since the start of 2025, whatever headroom Rachel Reeves left herself after the October budget, £9.9 billion headroom, which, by the way, was the third smallest headroom in history, appears now to have been wiped out. So that's why the Conservatives, the opposition, are branding this as an emergency budget. But of course, Rachel Reeves has said her fiscal rules are non-negotiable. There won't be any more tax rises. She already did that in the October budget. So it looks like today the money's going to come from spending cuts, which is pretty awkward because she's also, you'll remember, Tom, said that there wouldn't be austerity.
From a Labour government, uncomfortable for backbenchers at the very least, some in the cabinet as well. Where is she going to be finding the revenue? Where is she going to be digging behind the sofa then for additional revenue?
Well, Tom, our economists calculate she's got to find £17 billion. Now, we already know that she's going to cut welfare by £5 billion. There's been some accounting wizardry in that they've cut the aid budget to fund defence, but that counts by her rules as investment. So that gives her £2.4 billion. And that leaves £10 billion that's going to have to be shaved off departmental budgets, day-to-day spending. And we'll find out what the total of that is, but we won't find out exactly which departments will feel the pinch until the spending review which comes in June. Now, you've talked about how politically difficult this is. We can come back to that. But really, on a big picture level, this headroom, whatever she leaves herself today, could be wiped out again by the October 2025 budget, given the global uncertainty. You know that we've got Trump's Liberation Day on April the 2nd, all these tariffs coming into place. Yes, the UK might not be directly in the firing line, but it could be in the crosshairs of the retaliation. And that comes into force just days away from the payroll tax hike that Reeves announced back in October. So by later this year, it could be that Reeves has to come back with another budget. And when I spoke to her last week, she was not apologetic about her previous tax rises. Now, just coming back to the politics of all of this, you mentioned how there's disquiet, not just among the backbenchers, among the left wing of her party, but also in the cabinet. I would say, look, the trouble is, and this is a Chancellor I have been interviewing since before she took office here, this is somebody who's been watching the Liz Truss debacle with fear. She does not, Rachel Reeves, want to upset the bond vigilantes today, and it may be that she's more afraid of them than she is of the left wing of her party.
Yeah, and that in the context of the 10-year yield here in the UK, gilt's up about 100 basis points in terms of the yield just since September. Bloomberg's Lizzie Burden in Westminster with the preview. Thank you, Lizzie. We're going to have a special coverage, of course, of the Chancellor's spring statement today from 12:15 p.m. UK time. Subscribers will also be able to watch on the terminal, and we will be live streaming our coverage on YouTube. Coming up, HSBC doubles down on Asia and the Middle East. We're going to speak exclusively with the bank's head of Europe and America's banking at the Lenders Global Investment Summit in Hong Kong. That's coming up. This is Bloomberg. A Bloomberg analysis has found that Chinese banks are snapping up bankers who were laid off from Wall Street firms in Hong Kong, reversing a trend from previous years. Around 40 bankers have joined Chinese brokerages in the last 12 months. Meanwhile, HSBC is doubling down on operations in Asia and the Middle East. Let's cross over right now to Bloomberg's Rebecca June-Wilkins, who stands by for us at the HSBC Global Investment Summit with another very special guest. Rebecca.
Thank you so much, Tom. Yes, we are here live at HSBC Summit, and we are speaking with HSBC's Europe and America's banking head out of the bank, of course. Gerry, it's such a pleasure to have you here with us.
Thanks for having me.
You know, I sort of know you through and through as a credit and private credit guru, really. So let's start there.
All right.
Trends that you're expecting to see through this year, and are we going to see that sort of uncertainty resolve itself in any way?
Sure. Well, look, the year started out just in unbelievable form. We were coming off of 2024, which was an all-time record year in the credit markets for new issuance. And two things happened. One, obviously, we had a huge amount of volatility in the equity markets that dampened risk appetite, most recently off of Trump's comments on March 10th around the potential for a recession in the U.S. and him not sort of swatting that away in the way that you would have expected him to. You know, that sort of reaction has flown through the credit markets in the form of reducing appetite in the immediate term for some of the most risky credits. What we're finding, though, is that the market, which started out with about 65% of the market trading above par in January, that's come down to about 15%. So the wave of repricings that we've seen has now kind of come through the chute, and the market has found a good, steady level of issuance where credit's available in size for transactions that the market's willing to absorb, and we feel very optimistic about that remaining open for the rest of the year.
I mean, one unexpected challenge of this year, we started the year thinking that essentially President Trump was going to unleash global deal-making with this deregulation push, and instead the tariff concern has really been very, very prominent. What I've been hearing a lot from investors here is this issue over uncertainty.
Sure.
So I guess I want to ask, how long do you think that it takes to resolve some of that? What is it that the markets really need to see here?
Sure. Well, look, notwithstanding that uncertainty, we are seeing a meaningful uptick in M&A supply coming through the credit markets. We have line of sight on probably 20 billion of issuance in the next couple of weeks coming through the market. And so, you know, while animal spirits are not fully back, we're in a much better position this year versus last year, with announced M&A being up about 13% year over year. That, combined with a positive tone in the credit markets, means that we'll continue to be able to get business done. As to what exactly is the moment that will signal total clarity on tariffs and geopolitics, I think that will remain uncertain. Obviously, we're all looking forward to April 2nd to see what the Trump administration announces on the day. But for the most part, I think what we're seeing in the credit markets is relatively accommodative conditions. And so the equity markets have been a slightly different story. The credit markets remain very healthy.
At HSBC, of course, you're known as sort of this debt underwriting powerhouse. How are you viewing risks around private credit right now? Are they shifting at all?
Well, so look, in private credit, I think, one, private credit is undertaken by some of the largest platforms in the world who are some of our biggest global clients. Mm-hmm. And so we support their originations in private credit through financing for their platforms. And for us, that's some of the best risk-adjusted return in banking right now. And so our support for those platforms allows them to continue to deploy credit that has, for the most part, moved outside of the banking system, either because it was higher leverage or higher risk than our regulators want us to take on. And we view that as sort of having achieved an equilibrium where both private credit and bank credit can thrive. One of the things that we're seeing come through the syndicated loan markets now are transactions that had been executed in private credit format over the last couple of years when conditions in the syndicated market weren't quite so healthy, and now it's coming back through to the syndicated market because terms are attractive, pricing's attractive, and so we believe both can and will continue to coexist.
The other big push has been for banking innovation.
Yeah.
I'm curious what your ambitions are in Asia specifically, and also what are some of the challenges are.
Sure. So innovation banking, we're a little over a year into the innovation banking proposition at HSBC. It's been a resounding success. It's now led globally by Dave Sabo, and we're extremely excited about the effort that we have against what is really a full ecosystem of clients and partners in the innovation space. We cover everyone from the founders, the LPs, the GPs, the funds themselves, and end-to-end for the opportunity set so that we consider ourselves a partner for those clients through the entire life cycle. We're able to plug them into the global network that HSBC operates. We're in 60 countries. We cover 90% of all the capital flows in the world through our network and are able to, through that, really create scale for these companies faster than anyone else that they had previously worked with. And so we're finding that we're a really attractive partner for them as they try and grow and scale their businesses. And last, in terms of global capital flows, George, our CEO, highlighted this morning in his opening remarks here at GIS that of the 20 biggest corridors for financial flows, 16 of the fastest growing are either intra-Asia or between Asia and the Middle East, and 13 of the largest in aggregate are either intra-Asia or in between Asia and the Middle East. And we're seeing that play through in our innovation ecosystem.
Okay. And a quick, but we have 30 seconds or less.
Okay.
I know you have this good window into US corporates into China. So I'm thinking about, capital flows here. What do you expect? Obviously, it's been tough in terms of FDI. What are you expecting for 2025?
Look, I think, for all the noise that you hear in the news, Asia remains the prize for our clients. And the clients that are headquartered in the US and not doing business in China are finding that conditions are actually improving steadily. We've seen a number of new measures coming out of the government. There's a 30-point plan to support consumer spending and to try and stabilize the wealth effects both through the market and through the real estate markets. And I think what we're starting to see are a stabilization and a sort of broad collection of the market and growth from there. So we remain optimistic.
Okay, Gerry, a pleasure to have you. Thank you so much. That's great. Gerry Keefe, Head of Banking, of course, for Europe and Americas at HSBC. Tom, back to you.
All right, great conversation. Asia remains the prize for our clients. Bloomberg's Rebecca June-Wilkins speaking with HSBC's Europe and America's banking head at the bank's Global Investment Summit, of course, in Hong Kong. Coming up, President Trump announced an investigation into how a journalist was added to a text group with top officials. We'll get the latest on that controversy next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other news making the headlines this Wednesday. President Trump has announced an investigation into how a journalist was added to a text group of top US officials discussing plans for military strikes in Yemen. He's expressed support for his national security advisor, Mike Waltz, and he suggested procedures might not change in the aftermath, with a criminal investigation unlikely. Waltz says he takes full responsibility.
We're going to get to the bottom of it. I just talked to Elon on the way here. We've got the best technical minds looking at how this happened. But I can tell you for 100%, I don't know this guy. I know him by his horrible reputation, and he really is the bottom scum of journalists. And I know him in the sense that he hates the president, but I don't text him. He wasn't on my phone, and we're going to figure out how this happened.
Mario Draghi says Germany's decision to increase defence spending is, quote, a game changer. But the former ECB president and ex-Italian prime minister has warned of risks on how it's implemented. Draghi also said it's not in Europe's interest to retaliate against US tariffs. That's because it's far more reliant on trade than the US or China. Coming up, we are, of course, counting down to the UK's CPI inflation data out at the top of the hour, that ahead of the Chancellor's spring statement. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Partial truce. The US says Russia and Ukraine have agreed to a ceasefire in the Black Sea, ensuring safe navigation on shipping routes. But the Kremlin says a deal depends on some sanctions relief. US copper futures surge on a Bloomberg report that President Trump could slap import duties on the metal within weeks. The president also says he wants to limit exceptions on reciprocal tariffs. Plus, the UK Chancellor looks to slash billions in spending as the government faces global headwinds and critics within its own party. We look ahead to Rachel Reeves' spring statement. So, a focus on UK equities, a focus on the pound, of course. We have inflation data before the spring statement. The inflation data dropping at around 7 a.m. UK time, with the headline expected to come in at around 3%, in line with the previous month. European futures currently looking for direction after some gains yesterday of around 0.7%. FTSE 100 futures also flat so far in the session. Inflation data and the spring statement could, of course, change the direction for UK equities in the session. S&P futures pointing to losses of 0.1% after 3 straight days of gains for US stocks. Nasdaq 100 futures also pointing lower by 31 points. You had consumer sentiment confidence data coming out in terms of the surveys out of the US falling in March, the lowest level in 4 years. Let's flip the board and have a look cross asset. Yields are actually up across the curve so far in the session. So checking in on the US benchmark 10-year. Yields up 2 basis points, 4.33 right now on the 10-year. The pound, of course, in focus ahead of the spring statement, and inflation 129 right now on the pound. Copper as well. That's the COMEX. That's the exchange, of course, in the US in terms of pricing. Massive divergence between what we're seeing in pricing on the COMEX versus the LME here in London. 1.5% is the upside on the tariff risk around copper and restricted flows out of Chile as well. Brent trading at $73 a barrel, up 0.3%. Briefly checking in on Asia as well, where the benchmark MSCI Asia Pacific is currently in positive territory, up 0.2%, as you can see. CSI 300 on mainland China down 0.4. The HS Tech Index rebounding to some extent after some pressure in recent days, up 0.6%. And over in Japan, you're seeing gains of 246 points. Let's get back out to Westminster, Abingdon Green, with the preview, of course, of the spring statement. Chancellor Rachel Reeves expected to slash UK government spending by billions of pounds when she unveils that statement later today. Bloomberg got the views of former Chancellor George Osborne on the sidelines of the HSBC Global Investment Summit. Take a listen.
The overall message needs to be a bit of a reset, frankly. The government didn't get off to the best of starts, although it had a lot of goodwill, and it inherited problems. But the result is at summits like this, on the other side of the world, there's quite a negative sentiment about the UK, and that needs to be changed.
Bloomberg's Lizzie Burden is in Westminster for us on Abingdon Green. Lizzie, can Rachel Reeves then hit the reset button in terms of the economic fortunes of the UK?
Well, I would love to be more optimistic, Tom, for you, but the sluggish growth picture in the UK and the rise in government borrowing costs, the rising gilt yields since the start of the year mean that it's pretty likely that her headroom has been wiped out, her headroom against her fiscal rules. And our economists judge that she's actually going to have to find £17 billion down the back of the sofa today. Now, this is going to be politically difficult because Reeves already told us that she only wanted to have one budget a year. The Conservatives are branding this an emergency budget. She told us that she didn't want a return to austerity, but it looks like there are going to be departmental spending cuts on top of the welfare cuts that have already been announced, on top of the cut to the aid budget to fund defence, on top of that cut to the pensioners' winter fuel allowance. So to many in her cabinet as well as her party, this is stuff that a Labour Chancellor has no business doing. And you ask, can she hit the reset button? The trouble is, given the global headwinds, it may be that whatever headroom she leaves herself today could again be wiped out by the October 2025 budget, and then she may have to come back and do even more. When I spoke to her last week, she was not apologetic about the tax rises that she did last year. Do we see more of those ahead? As one economist put it to me this week, and I think that this is what George Osborne was suggesting, it may look from the outside perspective like the UK's had government after government that simply appears to just be managing its decline, Tom.
OK. Bloomberg's Lizzie Burden, ending on that bright note. Thank you very much indeed, joining us out of Westminster, ahead, of course, of the spring statement. And Lizzie will be covering all of that for us throughout the day. Thank you, Lizzie. Let's get more of a perspective right now in terms of what all this means for the UK equity markets and bring in Tineke, Frikkee, who is head of UK equity research at Waverton Investment Manager. Thank you very much, Tineke, for coming into the studio. Where is your focus going to be then with that lens on the UK equity market? What is of greatest importance when it comes to the spring statement?
Well, overall, of the greatest importance is that there aren't any big surprises. People obviously think back of the Truce times when there were a lot more surprises. So it's not just the equity market who will be watching this carefully, it's also the Treasury market. Because it's clear that if we look at the progress reports that the Chancellor will be looking at, economic growth hasn't picked up, inflation is still high, and it looks like the headroom that she had in October has turned into a loss. So there's things haven't gone the way. Now, obviously, adjusting every 6 months is unhelpful for markets. So, we will hear some more spending cuts, but the equity markets will really hope that from a company point of view, they can still plan ahead based on the changes that we already know, because we know that the national insurance contribution will go up in April. What impact will that have? So there's plenty that business has to worry about, and then we, have to see what the tariff changes actually will do.
So on the gilt markets, yields are up on the benchmark 10-year by about 100 basis points since September of last year. Are you suggesting the bond vigilantes are waiting in the wings at this point for the UK Chancellor?
Well, this is nearly...
How sensitive are the bond markets at this point?
I think quite sensitive, because what they don't want to hear that there's going to be either a lot of new debt issuance that will have an impact on the UK gilt market, but also maybe a bit more insight in how this big debt pile is going to be refinanced, because at the moment most of this sort of 30-40-year debt is being refinanced with 30 to 40-year debt, and that's really very expensive. So I'm not sure if the Chancellor is going to touch on that, but there could be more efficient ways of financing that, and that has an impact on banks that deal with that, but also with holders of gilts.
On a benchmark basis, FTSE 100 is up about 6% year to date. The FTSE 250, the small and mid caps, down around 3%. So there's some divergence there. What is your outlook for UK equities as you weigh up all of these different variables? Is there further upside to the FTSE 100 at this point?
Well, it's always difficult to know exactly what's driving that difference, but we believe that the FTSE 100 generally has a lot of larger international value stocks, and what we've seen year to date, that particularly growth and technology stocks have taken a step back, and the cheaper companies have done well, and that is exactly what the FTSE 100 has, lots of cheap companies. Now the FTSE 250, they're more domestic based, and we just touched on that UK economic growth is just not happening, and this is really hurting these.
Does that divergence continue then through this year? I mean, are you targeting particular levels on these indexes? And is that divergence the story of 2025?
We don't really think about, we sort of pick stocks, and generally we pick global growth stocks regardless where they are listed, and there are quite a few in the FTSE 100. But what happens to the UK economy, what happens to the pound is really important. We've seen some pound strengthening. Typically that benefits some domestic companies because they may buy things in US dollars and then sell it in pounds. So there's some dynamics happening. If the tariffs go not the way we want them, in general, international companies, so FTSE 100 companies, will be impacted more than domestic companies. So I wish I had a crystal ball. There's lots of moving parts here.
So what are you buying at this point?
Well, at the moment, we are continue just to focus on companies that sort of have a structural growth advantage, and we need to be very, very mindful of what tariffs do to that. But ultimately, we don't know what happens. Are the tariffs simply going to be passed on, and then gradually the end consumer is just going to pay more, and we're in inflation? So cautious optimism is sort of something that we follow closely.
OK, cautious optimism. Thank you very much indeed. Tineke, Frikkee, of course, head of UK equity research at Waverton Investment Management, as we lead up to that spring statement. What to watch, of course, and what is salient for these UK equity markets. Thank you. We're going to continue the coverage, of course, that statement at 12:15 p.m. UK time in terms of the coverage That's when it starts. Subscribers will also be able to watch on the terminal, and we will be live streaming our coverage on YouTube. Now, some other stories making news this Wednesday. Santander, within the banking space, of course, has become the first EU bank in almost a decade to be valued at more than 100 billion euros. That's as investors increasingly pile into the banking sector. Europe's banks have had their best winning streak since before the turn of the millennium. Shares of Europe's banks have been soaring in recent years after the ECB ended a period of negative interest rates in 2022, giving a massive boost to bank profitability. Shell CEO Wael Sawan says the company will continue to look for potential acquisitions, but he's warned of the risks inherent in pursuing a major deal. Speaking to Bloomberg, he didn't answer directly whether Shell would consider looking at its rival BP.
The bar is high, because if you're going to go for a big acquisition, one has to recognize that that can potentially distract, and therefore we're very focused on making sure if we do something in the inorganic space that the bar is high and that we go in ready to do that.
CK Hutchinson is said to be going ahead with the plan to sell 2 Panama ports to a BlackRock-led group. Bloomberg has learned the parties aim to sign an agreement by April the 2nd, with the sale netting $19 billion for CK Hutch. China has criticised the deal, with Beijing directing officials to investigate potential national security and antitrust violations. And Bloomberg has learnt that US tariffs on copper imports could come within weeks, which would be months earlier than the deadline for a decision. That sent copper trading in New York to a record, with the metal since paring some of its earlier gains. For more, let's bring in Bloomberg's Brian Fowler with the details. Brian, what could be the global impact then of these copper tariffs? We've seen the divergence, and dramatic as it has been, between the pricing in the US versus here in the UK, the LME. The global impact of these potentially 25% tariffs on copper.
Yeah, I mean, the bottom line is inflation. So as you said, copper was at a record. That's partly because of output stoppages in Chile, but really it's because of notions that these tariffs will kick in a lot earlier than previously thought. And so we've got a lot of companies rushing to get ahead of those duties by front-loading those imports. So there's a supply squeeze in the U.S. As we heard earlier in the show, U.S. prices are higher than they are on the LME, and that puts a lot more pressure on U.S. manufacturers. We've already seen that U.S. manufacturers are paying more for aluminum and steel and other building supplies than their counterparts overseas because of tariffs. This would, of course, increase that burden on them, so we could see U.S. manufacturing lose some of its competitive edge for a short term. The long term, of course, the hope from the Trump administration is that the tariffs will encourage more producers in the U.S. to boost output, and that would reduce the reliance that the U.S. has on overseas suppliers, especially China. But I think, it's right now, it's especially a squeeze in the U.S., but if those tariffs kick in, at 25%, as you say, I think we're going to see inflation go global, really, for all users. And of course, copper is a ubiquitous metal in wiring for everything from houses and buildings to cars and machinery. So it'll hurt everybody.
OK, and there's the important context as we count down to these potential tariffs on copper then. Bloomberg's Brian Fowler with the details. Thank you, Brian. Coming up, funding for European startups has hit a record high. It hit a record high in 2024. It's still dwarfed, of course, by US figures. We're going to do a deep dive in terms of the funding landscape. That is next. This is Bloomberg. Europe's talent pool has reached new heights despite funding shortages. Venture capital investment in the region's startups reaching over $52 billion last year. That's according to the latest report by Orrick, Europe's leading VC law firm. For more on this, we're joined by partner at Orrick, Jamie Moore, who's been scrutinising the data coming through with this report. Jamie, thanks for joining us in the studio. You've been looking at deals about 375 venture capital and growth equity investments then amongst your clients and partners. What stood out to you in terms of some of the themes, some of the transitions that's happening within this space?
Yeah, absolutely. Thanks for having us, first of all. So 2024 was the recalibration year, if you will. So we had the highs of 21, the lows of 23. What was really nice last year was to see a complete reset on some of these deal terms. So 2023 was crunch time. We saw a huge focus on investor consent rights, horrible positions with respect to liquidation preferences and things like this. For the first time, finally, we're seeing a bit of a rebalance of those terms, and that's clearly kind of set out within our report.
And that's because 2023 was a really challenging year in terms of access to funding broadly.
There's that, and also 23 was a huge expansion of the seed market. So there was simply a huge number of early-stage businesses with unproven business plans and things like this. So quite naturally, the kind of stress on those deal terms was high, but also the amount of money was low as well.
Which parts of this ecosystem, tech ecosystem in Europe, are attracting the most capital at this point?
Yeah, great question. I find that we're finally reaching what I would say the maturation of the AI market. So we're no longer worrying about whether we're on the application side or the infrastructure side. And actually, that's now creating this new space of SaaS, which is ultimately just flying with respect to financings. If you're B2C, then I think you're probably struggling right now.
That's really interesting that you see the AI piece maturing. Does it look frothy to you, or does it look rational?
It's improving.
Yeah.
Certainly not some of the crazy valuations that we've seen in prior years. I have had a few deals recently where no investor really wants to sit behind the pricing of them. But for the most part, it is getting a lot more reasoned, a lot more rational, which is...
What are your assumptions? What assumptions are you making around deal activity through 2025 then?
I mean, if my inbox is anything to go by, it's certainly very encouraging right now. I've got a huge amount of M&A, which is already kicking off the new year, which is promising. I don't think we're necessarily back to pure happy exit zones, but we are seeing a huge amount of secondaries, as we've seen in the report, and a number of companies getting some liquidity away at the start of this year, which is good. On the financing side, that's certainly picking up as well. So I'm ultimately very positive, which is nice.
And on secondary transactions, those have picked up significantly. Is that largely down to the public markets essentially being all but closed off at this point? And what is your sense as to when the public markets kind of become an easier place, when listings start to pick up again, essentially?
Yeah, I think that's probably right. So we're seeing a number of our later stage companies being in a bit of a holding pattern for that liquidity point. So a few bridge financings going through instead of exits, people actually taking proper time to prepare for those exits, which is really nice as well.
Okay, so there's not necessarily an unhealthy dynamic.
Yeah.
Growth stage funding. This has been a theme in Europe in terms of how it's limited, and you're still seeing that. What is holding growth stage funding back at this point, and what would need to happen to change that dynamic?
Yeah, great question. I think there's probably been a shift in focus points for some of these companies. So instead of, and that actually goes to some of the deal terms that we're seeing as well, right? So instead of people going crazy to hit rocket valuations, nowadays it's more about creating a more sustainable, reasoned business and dare I say it, profit, right? Which is quite nice. So actually, I think there's been a shift in what founders are thinking about. So it's no longer achieving unicorn status. It's actually achieving a sustainable, healthy business. Access to liquidity is obviously going to slow down later stage growth. And naturally, I think, to be quite honest, we're going through the tail end of a surge of financings where valuations perhaps haven't been so great. And so if there is a growth financing, it has to tick a number of additional boxes that they perhaps weren't needed beforehand.
On AI, and you touched on this, to what extent is the excitement, some would say euphoria, some would say irrational euphoria, around AI drawing funds away from other sectors? Are you seeing that at all? Is that a challenge for the space, or is it more nuanced than that?
Yeah, I'd say we've been doing AI for a long time. Yeah. I think this is the second wave of AI, or maybe, dare I say it, like the third wave. I've been doing venture deals for over 15 years, and when I was doing venture deals 15 years ago. So, it's not necessarily a new thing, but it's a slightly nuanced thing. I wouldn't say money is being drawn away from other companies because of AI deals. Because ultimately the check sizes are very different. The approach to those financings are very different. They're very different investor classes. So naturally, someone that's raising money for B2B SaaS is going to be very different from an AI company with like hard to value prospects.
Okay, Jamie, thank you very much indeed. Really interesting insights into the fund flows and the deal making within the European tech space. Jamie Moore, partner at Orrick. There's plenty more coming up. We're going to break down what's happening in terms of the US consumer. Look ahead as well to UK inflation dropping in 8 minutes' time. Stay with us. This is Bloomberg.
I do believe that investors are reassessing the parameter of this new global equation that is driven by the geopolitics and the tariff.
And that uncertainty is driven ultimately by the underlying outlook of inflation. Inflation is going to be an important driver of the rates outlook.
Tariff war is likely to cause a rise in inflation somewhat and a slowdown in growth.
Tariffs in general is going to be massively hurtful in the short run. I was talking about the unexpected consequence of Chinese companies having to find other markets. But overall, I think, though, China has kept a very firm message that they're going to keep globalization firm and even unilateral reduction in tariffs if possible.
Guests at the HSBC Global Investment Summit in Hong Kong with their thoughts on US tariffs and the impact on trade. And certainly that is in the mind of US consumers as well. The concern about the tariff impact, the concern about higher prices, and you're seeing that in terms of the consumer confidence gauge edging to its lowest level, and that's the blue line, in 4 years. The bottom line, the white line, is expectations 6 months out, falling to the lowest level in 12 years. That does not paint a positive picture in terms of how the US consumer is feeling. But we, of course, need to see how that impacts retail sales. And that is the gap at the moment. Let's flip the board and have a look quickly at the copper story. This is remarkable as well in terms of the divergence you're seeing in terms of pricing on the COMEX exchange in the US versus the LME here in London on reports that Trump is looking to add tariffs on copper potentially within the next few days, potentially in the next few weeks as well. And you've seen a suspension as well of exports from Glencore out of Chile. So those two factors coming to combine with much higher prices, record prices on the COMEX exchange, again, diverging from the pricing on the LME. Let's briefly check in on gilts and the 30-year. This is the focus for Rachel Reeves, as is the 10-year. The concern, of course, leading up to the spring statement, she wants to balance those risks, and we know that she is focused on what the bond community is thinking, the investment community is thinking about that spring statement, her commitments around spending and those tax cuts. Yields, by the way, on the 10-year, up about 100 basis points since September. We're going to have live coverage, of course, of the Chancellor's spring statement today from 12:15 p.m. UK time. Subscribers will also be able to watch on the terminal, of course, and we're going to be live streaming on YouTube. The opening trade is up next. This is Bloomberg.